Hello everyone, Alex Kim here. Silver crossed $100 per ounce on Friday and didn't pause at that psychological level. By Monday, January 26th, it reached $116.07, up over 8% intraday. To put this move in context, silver closed May 2025 at $32.99. The current price represents more than a tripling in less than 8 months. What's unfolding now isn't just a price story. It's a liquidity crisis at the retail distribution level that reveals structural constraints in how physical metal flows through the supply chain when price acceleration outpaces the financial capacity of intermediaries. Many coin shops are entering what can only be described as crisis mode. The volume of silver being sold by the public has created a backlog that extends beyond retail dealers to wholesalers and refineries. Some dealers are now owed millions of dollars from refineries and wholesalers, with payment delays extending from typical 1-week settlement periods to 3, 4, or even 6 weeks. Even 6. Refineries are making partial payments rather than full settlements, attempting to manage liquidity across dozens or hundreds of dealer relationships simultaneously. One of the largest wholesalers in the country recently stopped buying silver entirely because they owe millions across their dealer network and lack the cash flow to continue operations at current volumes. This isn't speculation. This is positioning. The mechanics are straightforward, but the implications are significant. In normal market conditions, a coin shop buys silver from the public, holds it briefly, then ships it to a wholesaler or refinery who pays within days. That payment allows the dealer to buy more inventory from the next customer. The cycle depends on continuous liquidity at each node in the chain. When refineries and wholesalers become backlogged with physical metal, they cannot immediately process or finance, they delay payments. When dealers don't receive payments, they cannot purchase additional inventory from the public. The result is that many shops have simply stopped buying silver, not because they don't want the business, but because they've exhausted available capital and credit lines. The largest bullion dealer in Missouri posted publicly that they've stopped buying silver. This is not an isolated case. Dealers across the country are limiting purchases per customer, reducing operating hours, or closing temporarily because they're waiting on payments that would normally arrive within a week, but are now delayed by a month. Some shops are limiting customers to 100 ounces per transaction per week. Others have moved to appointment-only operations or compressed their hours to focus on processing accumulated inventory rather than serving walk-in traffic. One dealer reported buying approximately 25% more silver by dollar value than they sold last week, despite having healthy sales. The imbalance isn't from lack of demand at the retail level. It's from the rate at which the public is liquidating positions faster than end buyers can absorb the flow. Online sales have helped some dealers manage inventory because they can reach a broader buyer base, but shops without digital distribution channels are disproportionately impacted. The retail sales environment has slowed for walk-in customers, while the volume of sellers remains elevated. A Buffalo round, which typically costs around $30 to $35, now exceeds $110. A customer who previously spent $100 weekly on silver can no longer afford a single 1-ounce round. A 10-ounce bar, which was worth roughly the same as a kilo bar in May 2025, is now worth over $100. That price point creates both affordability constraints for buyers and security concerns for peer-to-peer transactions. The refineries processing this metal don't have infinite cash reserves either. They're currently quoting 15 to 19 days for payments, but those are partial payments designed to keep dealers minimally functional rather than fully settled. A dealer owed $1 million might receive $100,000 to prevent complete operational shutdown, but that amount is consumed by a single customer walking in with 1,000 ounces of silver, which is only 10 100-ounce bars. At 110 per ounce, even small transactions represent significant capital. A customer bringing in 100 ounces represents over $11,000 in required liquidity. The volume of these transactions is overwhelming the available working capital at the dealer level. Watch the flow, not the headlines. This isn't about whether silver is fairly valued or overvalued. It's about the operational reality that the physical distribution infrastructure was not designed to handle this pace of price appreciation combined with this volume of public liquidation. The system functioned when silver moved from $20 to $30 over several years. It's breaking when silver moves from $30 to $110 in less than 8 months. Are you seeing similar liquidity constraints in other physical commodity markets, or is this unique to precious metals distribution at the retail level? If you find this breakdown useful, consider subscribing so you can track how these distribution bottlenecks evolve. The correction risk remains a topic of speculation among dealers. If silver pulls back 10% to 20%, which would be normal volatility in a trending market, retail buying interest may return as affordability improves. Customers currently priced out at $110 may re-enter at $90 or $95. That would shift the flow dynamics back toward balance, reducing the inventory glut at the dealer level. However, the psychological barrier of 3-digit silver prices represents a mental hurdle for many buyers. Even if silver corrects to $95, that's still nearly triple the May 2025 close. The wealth transfer occurring for holders of physical metal is significant in dollar terms, but for those looking to exit positions, the available channels to convert metal into cash are shrinking daily. The frustration isn't from lack of theoretical liquidity. It's from the operational reality that the businesses designed to provide that liquidity have reached their capital limits. This is not a retail story in the sense that retail investors didn't drive the initial move. Central bank buying, industrial demand, and monetary concerns drove silver higher. Retail is now responding by liquidating accumulated positions, but the infrastructure to absorb that liquidation wasn't scaled for this scenario. Live capital comes at a cost, and dealers don't have endless money. Banks will only extend so much credit against bullion inventory, particularly when prices are volatile and the risk of a sharp correction exists. Some dealers are exploring alternative refineries or wholesalers they haven't previously worked with, but those channels are facing the same constraints. The issue isn't finding a buyer for silver at $110. The issue is finding a buyer who can pay immediately rather than in 4 to 6 weeks. For dealers operating on thin margins with limited working capital, that timing gap is the difference between staying open and closing temporarily. The security implications of peer-to-peer selling also escalate at these price levels. Meeting a stranger from Craigslist to transact $100 for a 10-ounce bar carries risks that didn't exist when the same bar was worth $330 in May. CoinShops historically removed that risk by providing a professional, secure environment for transactions, but when those shops can't buy because they lack liquidity, sellers are forced into less secure alternatives. The public narrative lags the positioning, which is why many outside the dealer community don't understand the severity of what's happening. Headlines focus on price milestones like $100 or $110 per ounce. They don't focus on the operational breakdown occurring in the distribution chain that connects sellers to ultimate buyers. One dealer reduced operating hours to 18 hours per week, split across 4 days, closing Saturday through Monday entirely, to focus on processing incoming inventory and fulfilling online orders. When shops are open, they're packed with customers, but the volume of administrative work required to manage the backlog makes longer hours unsustainable for single-operator businesses. Other dealers have moved to appointment-only models or temporary closures to catch up on processing and avoid getting further behind. The alternative is reaching a point where they must lock the doors for an extended period because they're buried in unprocessed inventory and unpaid receivables. The trickle-down effect is clear. Refineries stop buying from wholesalers because they're backlogged. Wholesalers stop buying from dealers because they're waiting on refinery payments. Dealers stop buying from the public because they're waiting on wholesaler payments. The only remaining option for public sellers becomes private sales to neighbors, friends, or online buyers. But those channels have limited depth and significant friction. None of this means silver's price move is unjustified or that the metal is in a bubble. It means the physical infrastructure supporting secondary market liquidity wasn't built to handle this rate of change. The system was designed for gradual appreciation over years, not tripling in 8 months. When price moves this fast, Financial constraints at each intermediary node become binding constraints on market function. The dealers still operating are walking a fine line. Those with diversified revenue streams, including online sales, have more flexibility. Those dependent entirely on walk-in traffic are disproportionately exposed. Some will survive this period. Others may face temporary or permanent closures, not because their business model was flawed, but because the capital requirements to operate in this environment exceeded what they could access through credit lines or accumulated reserves. The larger question is how long this imbalance persists. If silver stabilizes at current levels for several weeks, the backlog will gradually clear as refineries process accumulated inventory and payments catch up. If silver continues rising at 8% to 10% every few days, the problem compounds because the dollar value of inventory grows faster than dealers can convert it to cash. A 10% move when silver is at $20 represents $2 per ounce. A 10% move when silver is at $110 represents $11 per ounce. The absolute dollar volatility at these levels makes financial planning and risk management exponentially harder for businesses operating on tight margins. Silver doesn't move first. Stress does. What we're seeing now in the dealer network is stress manifesting through liquidity constraints, operational adjustments, and in some cases, business closures. That stress doesn't invalidate the underlying reasons silver appreciated. It reveals that the supporting infrastructure has limits that become binding when trends accelerate beyond certain thresholds. For anyone holding physical silver, the takeaway is that converting metal to cash may require more patience and creativity than in previous market environments. Coin shops remain the most secure and straightforward option, but their capacity is constrained. Online peer-to-peer sales offer better pricing, but carry security and logistical risks. Waiting for the backlog to clear is an option for those not facing immediate liquidity needs, but there's no clear timeline for when normal operations resume. For dealers, the path forward depends on cash flow management, maintaining relationships with wholesalers and refineries who are still operational, and making difficult decisions about how much inventory to accept when payment timelines are uncertain. Some are prioritizing gold over silver because gold still has functioning wholesale channels, while silver-specific channels have largely closed. The irony is that this distribution crisis occurs during a period when silver's fundamental story remains intact. Industrial demand is growing, mine production is constrained, and monetary concerns support continued interest in precious metals. But fundamentals don't solve operational liquidity problems in the short term. Those problems resolve through time, through price stabilization, or through capacity adjustments at the refinery and wholesale level. How quickly do you think the refinery and wholesale backlog clears? And what does that timeline mean for dealers trying to manage inventory and cash flow in the meantime? Share your thoughts below, and I'll continue monitoring how these distribution constraints develop over the coming weeks.